So at a time where the U.S. government is selling more treasuries than ever before, the buyers of treasuries don't want them. That's why the Fed is going to have to buy them. The Fed right now is selling treasuries. They're still doing quantitative tightening. But I think they're going to be forced to reverse that into quantitative easing. And that's going to send inflation through the roof. And I think the gold market already sees that, or investors. And that's one of the reasons why they keep selling dollars and buying gold. That's where they're going to be, because I think gold is not going to stop going up, because the dollar is not going to stop going down. It's not going to stop at 5,000. It's not going to stop at 10,000. It's going to go higher. I mean, it could go to 20,000. I mean, who the hell knows?
Peter Schiff isn't buying the story that the U.S. economy is strong. He argues the opposite. It's weak, and the cracks are widening. His point is straightforward. If the economy were really the best ever, as Trump claims, there'd be no reason to push for massive rate cuts. You don't slash rates when growth is roaring. You slash rates when you're desperate to keep the system from seizing up. For Schiff, the problem runs deeper than temporary shutdowns or short-term policy fights. It's the unchecked government spending, ballooning deficits, and the increasing pressure presidents place on the Federal Reserve. That kind of political interference erodes what little independence the Fed still has. Add in Trump's habit of treating the U.S. government like his personal business empire, leaning on corporations and manipulating markets, and Schiff sees a dangerous precedent that could destabilize confidence further. Against that backdrop, gold tells the truth. When it moves, Schiff says, it's not because of jewelry demand. Central banks are the buyers, quietly trading out of dollars and treasuries to accumulate hard reserves. That's a red flag from the very institutions that understand the monetary system best. Gold's climb isn't just another trade, it's a signal that something is breaking. And Schiff is blunt. As long as the dollar keeps bleeding value, gold won't stop at $5,000 or even $10,000. In his view, $20,000 gold is not just possible, it's where this path is ultimately leading. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
And I think it's going to get weaker. And I think, Donald Trump is out there saying we have the hottest economy in the world. It's the strongest economy ever, yet he's demanding massive rate cuts. And so those two are inconsistent, right? If we really have such a great economy, why is it so important that we get these massive rate cuts? But I don't think the rate cuts are going to strengthen the economy. I think they'll strengthen inflation, which will weaken the economy. And I think that's the box that we're now in. Because I think anything the Fed does on an interest rate basis or quantitative easing, which I think is our next, the next policy, but I think it's actually going to undermine the economy even more. So I think their stimulus is going to act more like a sedative, because I think the impact is going to be higher consumer prices and higher long-term interest rates, which will actually weigh the economy down. It won't, stimulate it. Well, first of all, they're never going to solve the fiscal problems. So the shutdown's got nothing to do with that. But look, it's all a charade. How many government shutdowns have we had? Yet the government is still here. I could get my arms around a real government shutdown where they actually shut down the government, but they don't. They don't shut it down. You know what they do? They shut down the national parks and they make a big deal. Oh, these people went to Yosemite and they couldn't get in, but most of the government is still operating. It's not like all the rules and regulations are somehow on pause. They still take taxes out of your pay. You don't get a break on the income tax or the Social Security tax because the government is shut down. No, the government is still there, ruining your life, making you have to work a lot harder. So they're never real shutdowns. They're just for show. They shut down certain things. And of course, they furlough a bunch of the government employees who love a government shutdown because they get paid. They just don't have to show up and go to work. Now, I just assume the government workers not go to work because usually whatever they're doing is screwing us up. It's probably better if they stay home, even though we pay them, because they're doing less damage if they're not at work. But look, it's all a political theater. The real problem with the government shutdowns is A, they don't shut down enough. and B, at the end of the day, they always reopen government back up. So we're stuck with it. So I don't really pay much attention to it. I think there's much bigger problems than the shutdown. The problems are the massive government spending, the huge deficits, the fact that now you have the president trying to hijack the Federal Reserve and stack it with a bunch of cronies to remove even a pretense of Fed independence. And then you have, Donald Trump, shaking down private companies, extracting concessions, taking stakes, micromanaging the United States as if it was his own private company, right? This is all part of Trump enterprises. I think this is a horrible approach to government. I think it sets a lot of dangerous precedents for future presidents to abuse the powers that Trump is usurping. I really hope the courts put a stop to what's going on. But, you mentioned gold's at $3,850. I mean, that's $150 less than $4,000. I mean, think about that. $150 and we're at $4,000 gold. This is not something that should be dismissed. When the price of gold is doing this, it's not like it's, the price of cheese, or something like that, or lumber or soybeans, because this is not about, oh, we got a bad crop, there was a drought, there was a flood, or there was just a big increase in demand for, corn or whatever. This is gold, right? It's not like Americans or everybody else all of a sudden wants a lot more jewelry, right? There's not a run on the jewelry stores. Gold is going up because of its monetary properties. It is a monetary metal. And when gold is rising like this, it is a warning sign, right? It is the canary in the monetary coal mine. And when you see this happening, it is a warning that something bad is happening. And, the biggest buyers of the gold are foreign central banks. Now, don't you think they know something? I mean, they're the insiders in the monetary system, right? And they're buying gold as fast as they can. And it's really like they're selling dollars, right? These are insiders that are dumping dollars, and they're dumping treasuries, and they're buying gold. Why are they doing that? Why are they foregoing the yield on U.S. treasuries to hold gold and have no yield? That tells you something. And in fact, Wall Street is finally recognizing this. A week or two ago, Morgan Stanley tweaked for the first time the 60-40 portfolio, that sacrosanct 60% stocks, 40% bonds. They decided to cut the bond portion in half and make it 20% bonds, 20% gold. Now, I've never seen that in my entire career. I'm 62. I started at 24 in this business as a licensed stockbroker. And during all those years, almost 40, right? I've never seen this. I was always like a lone voice in the wilderness on Wall Street, telling my clients to buy physical gold, right? Now, all of a sudden, more, wirehouse firms, institutional investment banks are for the first time saying you need to sell bonds and buy some gold because, there's a lot of inflation that you need to hedge. So this idea of 2% inflation, that's gone. Not that 2% was ever the holy grail or anything. I'd rather have no inflation than 2%, or I'd rather have prices go down 2% than up 2%. That's better, right? I mean, I want to buy stuff cheaper. I'd rather pay less, right? But now it's going to be way more than 2 because the Fed is cutting rates when inflation is at 3%, even the way they measure it, but it's on an upswing. So it's headed higher, yet they're cutting rates. So that tells you that the 2% target is out the window. What's the new target? Who the hell knows, right? They've never fessed up to one, but it's a lot higher. And so the world, I think, is de-dollarizing, and I think this is a big problem for the United States because America uses the dollar as a crutch. Our economy is so screwed up in a way because of the dollar status. We've been able to live beyond our means for decades. We can consume without producing, and we can borrow without saving. And that's made possible by the dollar reserve status. So the world is willing to manufacture goods and let us have them for dollars. And the world is willing to loan us dollars so that we can have lower interest rates. And, they're willing to buy our stocks to prop up our markets. But I think all that is going to be reversing. And I think this whole house of cards economy is going to come toppling down. And you're going to see a big increase in consumer prices and long-term interest rates in America, and a very substantial decline in the standard of living for most Americans. If half of the money in bonds at Wall Street firms went into gold, who the hell knows how high the price would go, right? I mean, first of all, it's going to impact bonds. Now, the bond market is a lot bigger than the gold market for now. Eventually the gold market might be bigger when the price moves up a lot more. But, what Morgan Stanley was effectively doing is putting out a sell signal on treasuries, telling its customers to sell treasuries. So that's going to have an impact. If more Wall Street firms want to sell treasuries, the central banks are selling treasuries, and the treasury is selling treasuries like they're going out of style, which they are, but they're selling more treasuries than ever. Our deficits are trillions per year. So at a time where the U.S. government is selling more treasuries than ever before, the buyers of treasuries don't want them.
Peter Schiff says investors are making a mistake if they keep waiting for some perfect correction in gold. In his view, those sharp 10% drops, or even 3 to 4% dips, aren't likely anymore. There's simply too much cash sitting on the sidelines, ready to buy any weakness. That means the people waiting for a pullback risk being left behind, forced to buy later at much higher levels. His advice is simple: stop thinking about timing trades and start thinking about escaping a sinking currency. You don't buy gold for a quick flip, you buy it to get out of dollars. And when it comes to price targets, Schiff doesn't see gold stalling at $5,000 or even $10,000. Over time, he believes it could reach $20,000 an ounce. History backs him up. He points to the Dow to gold ratio as the real guide. In 1929, the Dow was valued at 19 ounces of gold. By 1932, that ratio collapsed to just 1. The same thing happened again in 1980. Today, the ratio is around 12, already down from 40 just 25 years ago. If it falls to 2, that could mean the Dow at 20,000 and gold at 10,000, or the Dow flat at 40,000 with gold at 20,000. Let's get back to the interview.
Alec, I remember in early 2024, and I was critiquing this on my podcast, but you had a couple of firms basically downgrade Newmont and Barrick to sells. And they said that there's no more upside in gold. Gold was at 2,000, and the analysts were saying, look, gold is pretty much fully priced here. It's more likely to go down. And so there's no point in buying these gold stocks. And of course, since then, the price of gold has almost doubled. It's almost 4,000 now. And these mining stocks that they put sell recommendations on have more than doubled since they put sells on them. So Wall Street did not anticipate this trade at all. And they're only now starting to get positions. And that's why I think this move has got so far to go. I don't think there's going to be any substantial pullbacks. I mean, there'll be pullbacks for a day or two, but I don't think you're going to get, 10% drops in gold, or even, even 3 or 4% is going to be tough, right? Because there's so much money now waiting to come in that any dip is going to get bought pretty aggressively. And that's what I've been telling like my customers at Schiff Gold. I just keep saying, stop waiting for a pullback. You're going to be waiting forever. And then you're going to end up buying at a much higher price. Just buy. You want to buy gold, buy it. You want to buy silver, buy it. Don't get cute. Don't try to get a pullback, because even if you get a pullback, chances are it won't be enough and you'll miss it. By the time you buy it, it'll be higher. So just buy it, because what you really need to do is you're getting out of the dollar. The dollar is a sinking ship. The only unknown is how fast it's going to go all the way to the bottom. but we know that it's sinking. So the sooner you get off, the better. And the longer you wait, the higher the water level is going to be by the time you get off. So you just got to buy. And the same thing on these gold stocks. They've doubled, and some have tripled. But if you look at where they are in relation to where they were 10, 20 years ago, a lot of them are still a lot cheaper. But gold is much higher than it was back then. It's not just that the stocks are down. The value of the gold that they own is way up. And I think the earnings on these gold mining stocks are just going to explode. I mean, nobody has even put a pencil to a piece of paper to determine how much money these gold companies are going to make at $4,000 gold. And of course, we're not going to stay at $4,000 gold. Next year, we'll be at $5,000 gold, maybe $6,000 gold. So these companies are just going to make a ton of money. And, Wall Street is just like waking up to this, I mean, there is no Mag 7 in the gold stocks, right? We don't have any anachronisms. There's not, it's not like tech, right? Everybody is all over tech. So, the gold stocks are going to be, like that. I mean, at some point you're going to start to see, retail money coming in, meme stock money and stuff like that. But I mean, that's probably years away. It's the serious money that's coming in now. They missed the bottom. And the only reason I got the bottom is because I bought way early. It's like, because I saw this coming from a mile away. I prepared too soon. But so, I caught this entire move because I was already long, but I added to my positions back in the first quarter of 2024. I bought more gold stocks when they put these sell recommendations on. And then I bought more gold stocks for myself after Trump won at the end of last year and early this year when they dumped them. The market, they went down like 30% because everybody thought Trump was going to be so great for the economy. Hey, why do you want to own gold stocks when he's going to make the economy great? He's going to pay off the national debt and all this crap. I just bought, and I was urging all my clients to just, put more money in because I knew that this was a bunch of BS. And in fact, we had another opportunity right after Liberation Day. There was an initial sell-off of gold and silver stocks in particular. Silver stocks got crushed. If you'd have bought Liberation Day lows, people talk about the snackback. These silver stocks have tripled off those Liberation Day lows. But I think it's still early in this trade. I mean, I think a lot of these gold mining stocks are going to 5 or 10x even from here. Maybe it'll take another 5 years to do it I don't know, but that's where they're going to be because I think gold is not going to stop going up because the dollar's not going to stop going down. It's not going to stop at 5,000. It's not going to stop at 10,000. It's going to go higher. I mean, it could go to 20,000. I mean, who the hell knows? It certainly has a precedent. Look at the value of the Dow in terms of gold. The Dow right now is worth 12 ounces of gold. Now, it was worth 40 ounces of gold 25 years ago. So that's a 70% decline. But the Dow was worth 1 ounce of gold in 1980. And it was worth 1 ounce of gold in 1932. Now, it was worth 19 ounces of gold in 1929. So it shows you that in just a few years, the Dow went from 19 ounces of gold to 1, approximately. I mean, not exact. But that shows you how much stocks can go down priced in gold. And again, by the way, the Dow is lower today than it was 96 years ago. So all this is a bunch of inflation, right? To say, the Dow is 46,000. That's meaningless. Gold's 3,800. Gold was $20 in 1929. So of course the Dow is higher, but in real terms, it's lower. But I think that at a minimum, I think the Dow is going to get down to 2 ounces of gold. That'd be my target. So how could the Dow be worth 2 ounces of gold? Well, the Dow could go back to 20,000 and gold can go to 10,000. That's one way. Or maybe the Dow goes down to 40,000, which is not that big a move down. And gold goes up to 20,000, which is a pretty big move up for gold. But the important thing is the ratio between the two. But we've been falling for 25 years. The Dow is down 70% over the last 25 years. And this is one of the worst years it's ever had. The Dow is down maybe 25% or so this year in priced in gold. It's getting killed. It's in a massive bear market. I think Wall Street is just recognizing the fact that gold's not coming back down. Like gold's not going back down to 1,000 or 1,500 or 2,000. It's just going to keep going up. I mean, it may not go up in a straight line. It may not go up every day. But a year from now, the price of gold is more likely to be higher than it is today, not lower. And that is a whole new ball game for the gold mining stocks. Because gold mining stocks are forward-looking, right? You're supposed to try to figure out what are all these future cash flows worth today. And if you have an optimistic viewpoint on where the price of gold is going to be in the future, that means the earnings in the future are going to be a lot higher, and so will the discounted present value. If you're of the opinion that gold's going to go way down in the future, then you're not going to value these stocks very high because you don't believe the earnings are sustainable.
Rate cuts are usually pitched as fuel for growth, but in truth they often reveal the opposite, that the system is too fragile to stand on its own. The widening deficits, political pressure on the Fed, and creeping loss of faith in the dollar all paint a picture that doesn't match the official narrative of strength. Gold's rise, driven not by retail speculation but by central banks quietly moving away from U.S. debt, signals that the world's most informed players are preparing for a very different outcome. For ordinary investors, the trap lies in waiting for a textbook pullback that may never arrive. Liquidity is so abundant that dips are quickly swallowed, leaving hesitant buyers chasing higher levels. The bigger takeaway is that this isn't about trading cycles anymore. It's about defense against a currency system losing credibility. If history is any guide, the Dow-to-gold ratio points toward levels that make $20,000 gold a realistic marker, not a far-fetched dream. If gold does climb to those levels while the dollar continues to weaken, will it finally force policymakers to confront the debt-driven system itself, or will they simply double down on the very measures fueling the crisis? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.